There is a kind of investment that makes people feel instantly calmer. It has the right language around it.
Stable. Protected. Guaranteed. Conservative. Safe. No drama.
No violent price swings. No terrifying headlines. No red numbers flashing on a screen at midnight. Just the soft emotional sedative of feeling like nothing too bad can happen here. And that feeling has probably cost ordinary people more wealth than any market crash ever did. Because the investments most people call safe are often only safe in one very narrow, very misleading way. They may protect you from seeing loss. They do not protect you from experiencing it. That is the first thing millionaires understand. They know that risk does not always arrive like a storm. Sometimes it arrives like wallpaper.
Quiet. Constant. Forgettable.
It sits in the background for 10 or 15 years while your money remains technically intact, visibly stable, emotionally reassuring, and silently weaker. That is why wealthy people, especially self-made wealthy people, are often far less interested in what looks safe than what actually survives time. And those are not the same thing. Most people think of safety the way frightened people always do, the absence of movement.
No volatility. No uncertainty. No discomfort. No need to think too hard.
They want investments that do not disturb them psychologically. Investments they can hold without having to question themselves. That sounds rational.
It often isn't.
Because if your definition of safety is "I don't want to feel scared," you become extremely easy to sell to. That is the hidden mechanism here. The word safe is one of the most profitable words in finance, not because it is always true, but because it speaks directly to a very old human desire, the desire to stop feeling exposed. People don't buy safe investments only because they've done the math. They buy them because they are tired.
Tired of uncertainty.
Tired of complexity. Tired of hearing that everything is expensive and unstable and late. Tired of feeling one bad decision away from embarrassment. So when someone offers them an investment wrapped in certainty, what they are really being offered is emotional relief. And emotional relief sells beautifully. That's why so many people pour money into things that make almost no sense once you widen the time horizon. Large amounts of cash sitting idle for years. Low-yield savings products treated as long-term strategy. Certificates and fixed-income products bought not as temporary parking, but as permanent homes for capital. Insurance products disguised as investment genius. Guaranteed plans with layers of fees hidden beneath the comfort. Real estate deals sold on the promise that property is always safe, even when the numbers are lifeless. Structured products people barely understand, purchased because the downside sounds cushioned and the paperwork sounds sophisticated. Notice what all of these have in common. They reduce emotional friction up front. That is their magic trick. They make the investor feel responsible, adult, prudent.
No chaos. No recklessness. No gamble. Just discipline.
But millionaires tend to see a deeper layer that most people never train themselves to see. They ask a more dangerous question.
Safe from what?
Safe from daily price swings?
Maybe. Safe from inflation? Not always.
Safe from taxes?
Often no. Safe from fees?
Rarely. Safe from opportunity cost?
Absolutely not.
Safe from mediocrity? Usually the opposite. And that last one matters more than people think. Because the real threat to most lives is not financial catastrophe. It is financial stagnation that becomes permanent. Not losing everything. Never building enough. That is the kind of danger safe investments specialize in. They don't usually destroy people dramatically.
They domesticate them.
They keep them calm while the years pass. They preserve the sensation of caution while quietly stripping away the possibility of compounding. They make people feel like they are protecting their future when, in reality, they are often protecting themselves from the emotional experience required to build one. Millionaires, especially the ones who built wealth rather than inherited it, eventually develop a very different relationship with discomfort. They stop treating volatility as the enemy. They start treating ignorance as the enemy. They know that an asset moving up and down is not automatically dangerous. Sometimes that movement is simply the visible price of owning something productive.
A business.
A basket of businesses. A property with real economics. An ownership stake in something that can grow, adapt, earn, and reprice over time. What scares most people is not risk itself. It's movement. And movement is not the same thing. A stock portfolio can look terrifying and still be rational. A guaranteed product can look soothing and still be corrosive. This is where ordinary investors get psychologically trapped. They confuse emotional smoothness with financial strength. So they avoid the assets that feel wild and overallocate to the ones that feel civilized. They choose stillness over resilience. And stillness, over long enough periods, can be incredibly expensive.
Imagine two people.
The first wants peace more than growth. Not irrationally.
Just deeply.
They have seen instability. Maybe they grew up around debt. Maybe they watched their parents panic over bills. Maybe they lost money once and promised themselves never again. So when they finally begin investing, they are not really looking for returns. They are looking for emotional nonviolence. They keep most of their money in things that feel quiet. Their balance rarely drops much. Their statements do not scare them.
They sleep well. At least at first.
The second person feels the same fear, but interprets it differently. They decide that real safety cannot depend on appearances. So they build reserves, yes. They keep cash for liquidity, yes. But when it comes to long-term wealth, they buy productive assets and accept that the path will look less tidy. Some years are ugly.
Some months feel absurd.
The numbers swing. Headlines scream.
They feel doubt.
But underneath the noise, the engine is stronger. 10 years later, the first person feels prudent and oddly behind. The second person often feels battle-tested and increasingly free. That is one of the great emotional injustices of wealth building. The strategies that feel safest in the short run often create the most anxiety in the long run. Because now the first person is older. Prices are higher. The future is closer. The capital never compounded the way it needed to. And the emotional comfort they purchased at the beginning has matured into a much darker feeling later on. Regret disguised as caution. Millionaires learn to fear that feeling more than they fear volatility. They understand that the most punishing losses are often invisible while they are happening. Inflation is one of them. Inflation is such a strange enemy because it doesn't feel like theft in real time. It feels like inconvenience. A higher grocery bill.
More expensive flights.
Rent that suddenly sounds offensive. Services that cost more and deliver less. Years pass, and the same amount of money begins buying a smaller and smaller version of life. If your capital is sitting in something safe that barely grows, you are not avoiding risk. You are accepting a slow-motion guarantee that your purchasing power will weaken. And because that weakening happens gradually, most people do not emotionally register it as loss. They register it as life getting expensive. Millionaires do not make that mistake. They know cash is a tool, not a religion. They use it for flexibility, negotiation, emergencies, timing, sleep. But they do not worship it as a long-term investment strategy. Because cash over long periods has a personality. It makes you feel rich before it makes you feel trapped. That's why one of the safe investments many wealthy people avoid is simply too much money sitting dead for too long. Not because liquidity is bad. Because excess safety can turn into decay. The same pattern shows up in products marketed to cautious savers. The promise is always emotionally elegant.
Protect your principal. Lock in certainty. Grow steadily. Avoid downside.
It sounds almost parental. And sometimes those tools have a place. But the wealthy tend to be suspicious when safety has too much packaging around it. Why? Because complexity is often how mediocre returns are made to look intelligent. If a product needs a long explanation to make modest outcomes feel impressive, that alone should trigger caution. Millionaires often avoid many safe investment wrappers not because they hate structure, but because they understand who that structure usually serves.
The seller. The institution. The commission chain.
Not the person whose capital is being anesthetized. This is one of the most overlooked differences between rich investors and average ones. Average investors often ask, how can I avoid feeling stupid? Wealthy investors ask, where is the incentive misaligned? That question changes everything. It makes you suspicious of products that sound too clean. It makes you notice how often protection comes with surrender, of upside, of liquidity, of flexibility, of clarity. It makes you realize that some investments are called safe because they are safe for the company issuing them, safe for the advisor selling them, safe for the narrative being told around them. Not necessarily safe for your future. And then there is real estate.
Not all real estate.
That would be too simplistic. Many millionaires love real estate. They build fortunes with it. But not the version the average person calls safe. The average person often believes property itself is safety. Bricks equal stability. Ownership equals wisdom. Rent equals waste. Buy anything you can, hold it forever, and let time do the rest. That mythology has done a lot of emotional work for people. It makes them feel grounded. But millionaires tend to be more clinical than romantic. They do not buy real estate because it is real. They buy it if the economics are real. There's a difference. A bad property in the wrong area with weak cash flow, high carrying costs, poor liquidity, sentimental pricing, and endless maintenance is not safe just because you can touch the walls. It is simply a highly convincing way to trap capital. Wealthy people know an asset can look tangible and still be fragile. In fact, tangibility can make people even more irrational. They forgive bad numbers because the thing feels solid. They ignore poor returns because at least it exists physically. They call it safety when what they really mean is familiarity. Familiarity is powerful. It can make mediocre decisions feel noble. That's why a lot of people buy local real estate they barely analyze, simply because it feels more trustworthy than owning a share of a great business they don't physically see. One feels abstract.
One feels concrete.
Millionaires are often less sentimental. They care less about what feels solid in the hand and more about what compounds in reality. And that same psychology appears in bonds, fixed income products, and capital preservation strategies when used badly. Again, the point is not that these are inherently foolish. Wealthy people use them strategically all the time. The issue is the emotional misuse of them. The overuse. The conversion of temporary caution into permanent posture. That is where safe becomes dangerous. Because safety, when overextended, starts costing you your future range. Your money grows too slowly. Your options narrow. Your working life lengthens. Your dependency increases. And by the time you recognize it, the consequences don't feel like an investment mistake. They feel like life got heavy for no reason. But there was a reason. You were paying to avoid psychological discomfort.
That is the hidden bill.
Millionaires tend to avoid investments that ask them to sacrifice too much long-term power in exchange for short-term emotional steadiness. They are not indifferent to fear. They simply know fear makes terrible portfolio architecture when put in charge. That's what makes this subject so personal. Most people do not choose safe investments because they've deeply studied capital allocation. They choose them because they are trying to become the kind of person who doesn't get hurt again. And that is understandable. But the market does not reward understandable feelings. It rewards sound structure. A portfolio built to calm your nerves at all costs may also quietly starve your future. That doesn't mean the wealthy are thrill seekers. Quite the opposite. Truly wealthy people often hate dumb risk. They avoid random speculation, status investing, hot tips, leveraged fantasies, and stories that require luck to survive. But they also avoid a subtler form of recklessness, pretending that a return-free existence is conservative.
It isn't.
It is merely still. And stillness does not protect you from the march of time. That's the deeper reframe most people never get taught. The opposite of risky is not stable. The opposite of risky is durable. Durability means your money can live through inflation, taxes, economic shifts, policy changes, missed opportunities, and the emotional weakness of your future self. It means the structure is strong enough to survive both panic and comfort. Because comfort can be just as destructive as panic. Panic makes people sell. Comfort makes people settle. And settling, financially, has a body count too.
Just a quieter one.
You see it in the person who worked hard for 20 years, did everything responsible, avoided obvious mistakes, never took wild bets, and somehow still ended up with far less freedom than expected. That outcome rarely comes from recklessness. It often comes from years of overvaluing safety theater. Money placed where it couldn't offend them. Money protected from movement but not from erosion. Money hidden in products designed to feel adult instead of perform well. Money trapped in assets chosen to reduce anxiety, not create strength. Millionaires don't entirely escape this. Some rich people are deeply conservative in destructive ways.
Some sit on too much cash.
Some confuse preservation with intelligence. Some become so afraid of loss that they stop deserving growth. But the ones who continue building, who keep expanding, not just defending, tend to understand a colder truth. If an investment's greatest virtue is that it helps you stop thinking, it is probably not serving you as well as you think.
Because real wealth demands thought. Not constant trading. Not obsession. Not drama.
Just clarity. Clarity about what a thing is.
What it yields. What it costs. What it protects against.
What it exposes you to. What it prevents you from doing. What it feels like psychologically. And whether that feeling is helping you or sedating you. That last distinction may be the most important one in the entire conversation. Some safe investments are not financial tools. They are emotional painkillers. And painkillers have their place.
In a crisis. In recovery. In transition.
In moments when the priority is stability, not optimization. But build your whole financial life around pain relief, and eventually you wake up in a body that never became strong. That's why millionaires often avoid the investments everyone else praises at dinner parties. Not because they crave danger. Because they have learned to distrust comfort that asks too little from reality. They know safety that cannot survive time is not safety. Protection that costs too much upside is not protection. Guarantees that preserve the number but weaken the life behind the number are not conservative. They are expensive forms of fear. And fear, when given a suit and a brochure, can look incredibly respectable. So the next time you hear the word safe attached to an investment, pause. Not because safety is bad. Because the word is incomplete. Ask what kind of safety is actually being offered. Safety from volatility? Safety from bad headlines? Safety from seeing a temporary loss? Safety from feeling uncertain? Or safety from becoming old with money that never learned how to grow? Those are very different things. And the people who end up wealthy are usually the ones who understand the difference early enough to act on it. They are willing to look unstable for a while in order to become stable later. They are willing to endure movement instead of worshipping stillness. They are willing to let their money do something alive. Because in the end, the most dangerous investments are often not the ones that might crash. They are the ones that feel so safe, so polite, so reassuring, that you never realize they were quietly stealing your future the entire time.